Hey folks, Andrew Packer here. Welcome to Trading Tips. In this week's video, I want to talk about one of the simplest and easiest options tools that you have that will allow you to help your stock portfolio as well. Now, I danced around it a little bit last week, but it's time we finally talk about selling covered calls. And in order to really show you the benefits, I want to first talk to you about one of the first bosses that I ever had in a job in finance. Now, for the sake of his privacy, we'll call him Roger. He was a great guy and an insightful boss. He taught me a lot. But one of the most important things he taught me wasn't direct. You see, Roger never really needed to work for a living. His grandfather bought shares of a company called the Computing Tabulating Recording Company way back in the 1930s. That company subsequently became one of the most powerful brands and investment returns of the 20th century. And getting out of the strict tabulating business it was in, they renamed it into a company that it's known for today, International Business Machines, or IBM. So my boss Roger didn't have to work for a living. The IBM shares that his grandfather bought provided huge life-changing returns for his family and then on to him. Now, usually if one generation builds a fortune, the second generation can only really manage it, and by the third generation, the cycle has moved from rags to rags once again. But Roger was different. While IBM shares were hardly the big growth name that they were in the 1950s and 1960s, and indeed really haven't gone anywhere in this last decade, Roger was able to use this option strategy of covered call writing to make more money out of the trade. So here's how it works. For every 100 shares of a company you own, you can sell a call option on the open market. And depending on the strike price and how much time you go out, you can easily leverage that to get 15 to 20% returns per year on your investment with very little risk of losing the underlying stock. Now, when you sell a call option, you're essentially saying that you're willing to get rid of the shares you own at a predetermined price. So for Roger, he was willing to sell at a price high enough that his likelihood of being called away was pretty much zero. So he was closer to making an extra 5 to 10% return on his shares. But in addition to the dividends he was getting, those returns and that extra percentage point gain was huge. It meant he could keep his shares for the future generations and just get better returns than just buying and holding the shares that he inherited. Now, obviously, this is someone of exceptional wealth, but that strategy is still a useful one, particularly for getting the best returns on your stock portfolio without taking on extra risk. For instance, in the last video when we talked about put selling using AT&T as an example, you could have instead bought shares and sold covered calls instead. So here's how it looks on the board. Now in that case, you would have bought 100 shares in the low 30s, let's just say 31. So that's a $3,100 commitment. Now on the plus side, you could be getting about $2 per share in dividends or $200 per year in straight income off that high-yielding company just from buying shares. But if you also sold covered calls at the money, you could make another $50 to $100 per month, or between an extra $600 to $1,200 per year, depending on where you sold the calls and where the shares traded over time. That means, adding up all of the total possible income you could be making, you could be getting up to 30% returns per year via dividends and covered call writing while still owning the shares. Now, if the shares rally, great, you'll make some capital gains as well. And if they don't rally, you can still make this market-beating return year in and year out, all for taking the risk of having your shares called away at a higher price, say 33 or 35. At some point, you might get taken out. But while the returns on selling covered calls would have been similar to selling put options on a regular basis, it does tie up more capital up front. As we saw last week, you would only have to put up a little bit of this amount to sell the put. Obviously, if you're going to sell the covered call, you have to put up this whole amount to own it first. But this strategy does give you the possibility of earning some capital gains and dividend payments in addition to the options income that you're getting along the way. So there are some advantages and disadvantages versus selling puts or buying shares and selling call options. Now, this is one of the least leveraged ways to use options because it's tied to an underlying stock position in your portfolio. But it is consistently profitable when used right. Now, while most investors are familiar with this type of covered call writing, there's a slightly more advanced strategy that I think is perfect to use in your portfolio right now. It's designed to use this covered call writing advantage as a way to increase your income, but also lower your cost basis on shares you own. So, given the recent market sell-off and how stocks historically rally going into the end of the year, I think it's a nice, low-risk way to use options to improve your returns going into the end of the year. So what's this strategy? It's called stock repair. And chances are you have one or two positions, hopefully not your whole portfolio, that are in tough shape right now following October's steep sell-off. So you can use this strategy to get into a better position going forward. Now, in order for this strategy to work, you must first add to your existing stake. So if you bought 100 shares of a company at 100 and they now trade for 50, you still think there's a great long-term value in the future here, you could consider buying another 100 shares. So here's how this looks on the board. With 100 shares at 100 and 100 shares at 50, you now have 200 shares with a cost basis of 75. So when shares go back to 100, instead of breaking even, you're now up $25 on your $75 cost basis, or a 33% gain. Now, that's an extreme example, of course, but again, with some of the big percentage drops in technology, the pot stocks, and other places this year, buying heavily oversold positions you already own and are sitting on a paper loss right now can really improve your future returns by buying down now. And that's just without stock repair, which is the second part of this strategy. With stock repair, you not only buy the additional shares and get your cost basis down, but you're also going to sell some covered calls on your position as well. Now, you don't need to sell calls on your entire position. If you go from owning 300 shares of something to 600, you could just sell 3 calls instead of 6. The idea behind this strategy is to use the power of covered call writing and the extra income potential to get paid to wait while you're waiting for the markets to recover. And of course, since markets fall faster than they rise, recoveries can take time. And selling time premium against that time is a great way to improve your returns. So to use a real-world example from my portfolio, earlier this year I had a small stake in Petrobras, ticker PBR, the major Brazilian oil company. Now, shares were rallying early in the year as oil prices were heading higher, but then some country-specific corruption scandal caused shares to dive, from around 15 to 9 within a matter of days. I used the opportunity to buy more shares and double down on my position. And I turned around and sold some $10 calls on the new shares that I had bought. And that was for an option that was for a few months out, but it sold for around $1.80, or 18% returns on the $10 strike price I sold. That's a great return that will allow you to beat the market time and time again if given the opportunity to do so by the market. So fast forward a few months, and the optimism over the company's prospects, as well as the election of a more free market-oriented political leader, led to a huge surge in Brazilian stocks. Shares of PBR have rallied back to their old highs, and by buying lower, I was able to make a small capital gain and a sizable return on the covered call part of the trade that I wrote. So my existing position swung from a gain to a loss, and then to a gain again, but my overall cost per share for the trade as a whole went down substantially by using this strategy. So this stock repair strategy can be done just about any time for any sort of company that falls on temporary bad times. Obviously, if a company has fundamental issues or some new development, you might want to just consider exiting entirely and taking the loss and moving on. But with this strategy, it means you no longer have to just sell out discouraged or simply wait and hope and pray that something will go better for the market. It also means if you do average down on an existing position that you're also going to start getting money out of the trade as it goes along right away from the covered call writing aspect of it. That's what makes this a very useful tool. And while the market is apparently past the worst of its fears from the October sell-off, there's definitely still a ways to go before markets get back to all-time highs. So stock repair is a great strategy to use options to boost your stock positions that are out of favor right now and get your cost basis down as the market's sold off as well. Now, as with put selling, covered call writing isn't the best tool all of the time. There may be a time when you simply want to get out of the shares that you own, and if that's the case, you should. But if you own a position that's just rallied 20% or more over the past few months, selling a covered call can give you a tremendous form of protection from those gains. After all, stocks generally go up over time, and many of them trade in patterns that tend to go up and down. And even though the ups win over time in the market, when you hedge after a big rally, covered calls can give you extra returns out of a position while waiting through the next downfall. So in short, covered call writing is a powerful tool. On paper, the returns can appear small, much like the put selling that we looked at in the last video, and how it's similar to simply making those gas money trades that I talked about each time you do it. But over time, it can mean the difference between a losing portfolio position and a winning one, or between good returns and huge returns. And right now, if you combine this tool with strategic additions to some of the beaten down positions in your own portfolio, you can turn a stock loss into a gain much more quickly. Covered call writing is one of the easiest ways to use options, and since you're using it to fine-tune your stock portfolio as well, it's a critical strategy to know and employ. So that'll wrap things up for this week. Thanks for joining us at Trading Tips. I'm Andrew Packer, wishing you good trading and good financial health.